Foreign investors can participate in the Indian stock market through several routes, depending on their investment goals, regulatory requirements, and the type of securities they wish to buy. India has established frameworks to facilitate foreign investment while protecting the market's stability and integrity.
1. Foreign Portfolio Investment (FPI) route.
Definition: Foreign portfolio investors (FPIs) are entities allowed to invest in India's financial markets under the Foreign Portfolio Investment Regulations. Registration: Foreign investors must register with the Securities and Exchange Board of India (SEBI) as FPIs. SEBI categorizes FPIs based on their risk profile and type. O Category I: sovereign funds, central banks, multilateral organizations, and other low-risk entities. O Category II: pension funds, insurance companies, asset management companies, and well-regulated funds. O Category III: high-risk investors, including individuals and corporate bodies.
Eligible investments: FPIs can invest in O equities, stocks listed on BSE or NSE. O corporate and government bonds. O derivatives.
O units of real estate investment trusts, REITs, and infrastructure investment trusts, INVITs. Limits: an FPI can hold up to a specific limit of a company's total equity, which is usually capped at 10% per FPI. For example, aggregate FPI investments in a company cannot exceed 24% of its paid-up capital unless otherwise approved.
2. Foreign Direct Investment (FDI) route.
Definition: Foreign direct investment (FDI) is a mode of investing where an investor requires a significant ownership, 10% or more, in a company, often with the intention to establish a lasting interest.
Eligible sectors: India has both automatic and approval routes for FDI.
O automatic route: in certain sectors, foreign investors can invest without prior approval from the government, such as the IT and telecommunications industries. O approval route: for certain sensitive sectors, e.g., defense, telecom, media, FDI requires government approval. Instruments: FDI is typically in the form of equity or direct ownership in unlisted companies or a controlling interest in listed companies.
3. American Depository Receipts (ADRs) and Global Depository Receipts (GDRs).
Definition: ADRs and GDRs are certificates representing shares in foreign companies, allowing investors to indirectly invest in Indian companies listed abroad. ADRs, issued in the United States and traded on U.S. exchanges. GDRs, issued outside the U.S. and India, generally in Europe. Benefits: ADRs and GDRs allow foreign investors to gain exposure to Indian companies without needing to register with Indian regulators or transact in Indian markets.
4. Participatory notes, P-notes.
Definition: P-notes are offshore derivative instruments issued by registered FPIs to foreign investors who are not directly registered with SEBI. How they work: FPIs purchase Indian securities and issue P-notes against these investments, allowing investors to participate indirectly.
Advantages: P-notes provide anonymity and simplified access to Indian markets for investors who may not want to go through the process of SEBI registration. Regulatory control: SEBI and the Indian government monitor P-notes to ensure transparency and to prevent misuse for tax evasion or money laundering.
5. Real estate investment trusts, REITs, and infrastructure investment trusts, INVITs. Foreign investors can also invest in Indian REITs and INVITs, which pool funds to invest in real estate or infrastructure projects, providing a way to earn returns without direct property ownership. REITs and INVITs trade on Indian exchanges and are regulated by SEBI, offering income from rents, tolls, and other infrastructure revenues.
6. Mutual funds and exchange-traded funds, ETFs.
Foreign investors can access Indian markets through mutual funds and ETFs listed on international exchanges, which focus on Indian equities or other assets. Some foreign fund managers offer India-specific funds that can be traded on US, European, or other exchanges, making it easier for retail and institutional investors to gain exposure without direct market entry.
7. Tax implications and currency exchange.
Foreign investors are subject to taxes on capital gains, dividends, and interest earned from Indian investments. Tax treaties, such as the US-India Double Taxation Avoidance Agreement, can sometimes help reduce these taxes. All foreign transactions must go through authorized banks in India, and foreign investors need to open a special non-resident rupee (SNRR) account to facilitate trading in Indian rupees.
Summary.
Foreign investors have numerous channels to access India's stock markets, whether through direct investments, derivative instruments like ADRs/GDRs, or funds that simplify the process. SEBI regulations and government policies encourage foreign investment while ensuring market stability, and many foreign investors view India's growth potential as a worthwhile opportunity despite regulatory and currency considerations.
Like and subscribe. Thanks for watching.